In this video, we're going to go over what margin is, what it means to use margin to buy stocks, some of the pros and cons of using margin, and what situations you might use margin in. So what is margin or margin trading? Trading with margin is using borrowed money from your stock brokerage to buy more stocks. Your own stocks or cash in your account are used as collateral for what is essentially a loan from your brokerage. Like any other loan, you have to pay interest to the lender. In this case, you're paying your stock brokerage. And the interest rates don't tend to be very good, especially as the Federal Reserve has been raising their own rates. Base rates you can get at most brokerages are around 11 to 12% as of the recording of this video. They do decrease if you have a higher account balance, but they're still not great. You'd have to get pretty unrealistic returns in the markets to justify taking out loans with these types of interest rates. But moving on from that, in the case that you either lose too much money on your stocks or default, your brokerage will force you to sell your stocks or deposit more money to recoup the value of their loan. This is referred to as a margin call. Your broker wants to ensure that you have enough money to repay them in the case your investments don't perform well, hence why the cash in your account or the value of your stock portfolio is used as collateral. What determines if you get margin called is referred to as margin maintenance requirements, which are generally set by FINRA, the primary regulating body of brokerage firms in the US. Typical margin maintenance is 30%. You have to have at least 30% of your account value in cash or securities of your own. That threshold can be higher based on your level of risk that you're taking on with your stocks. A more concentrated portfolio, meaning you own less stocks in total, the less your brokerage will let those stocks fall in value before making you sell out. The typical margin maintenance a brokerage will give you is 50%, meaning that 50% of your brokerage value is from your own money and 50% is from your brokerage. Your brokerage is going to make sure you pay them back in full, so when you lose money, it's not your brokerage losing anything, the value of your account is being lost. So for example, let's say you bought $20,000 of Microsoft stock, and let's say your brokerage is Fidelity. If Fidelity lends you $10,000 of that, and your own deposited cash is worth $10,000, that's the 50% margin limit, which is the max they'll give you in most cases. If Microsoft stock were to lose value, so the value of the stock you bought is now worth $12,000 from $20,000, you're now below that 30% margin maintenance requirement. So Fidelity would make you give them back their $10,000, and you're now left with $2,000. So what happens if you don't get margin called but you sell a stock? If you sell stocks you bought on margin, then that money is immediately returned to your brokerage. You can't decide that you want to hold on to it for any longer. So once you sell, that margin goes away. But what does this actually look like in your brokerage? What's the process here? Well, you can see it in the buying power on your account. This is a screenshot of my account on Fidelity, and as you can see, I have margin enabled. So I have margin buying power. Buying power is how much money you could use to buy stocks at any given time. If you have margin trading enabled, then you can see how much margin you have access to and how much money you have in your account without using margin as well. I have access to 2-to-1 margin. That's the 50% account margin limit I mentioned earlier. So I could potentially buy $46 worth of stocks since I have $23 in my account. To actually engage in margin trading, you have to have a margin account at your brokerage. Depending on what brokerage you have, this could be as simple as enabling it on your account or buying a subscription in the case of a brokerage like Robinhood. And in most brokerages, to be eligible to trade on margin, you have to have at least $2,000 in your account through cash or marginable securities. With that said, let's talk about the pros and cons of why you might use margin or not. For the pros, it's likely you'll need margin if you want to be a day trader. It takes several days for cash to actually settle in your account when you sell a stock. So in theory, you won't have your money to quickly make trades on the same day. So day traders have to use margin to be able to enter and exit positions. To potentially get access to higher levels of margin and be considered a day trader by your brokerage, you need at least $25,000 in your account. Other pros include using margin for short-term buying power. If you need to get out of positions for a relatively brief time due to different tax scenarios, situations like that, or borrowing money will potentially lead to higher gains. Doubling your buying power through margin will potentially double your returns. On the other hand, if your stocks go down in value, then you'll lose twice as much money. So this is definitely a risky strategy. Going to the cons, as I mentioned earlier, margin is incredibly risky. I can't stress this enough. It can lead to making more risky decisions and thinking through an emotional lens. That is never a good way to invest. Another con is the potential of a margin call. In the case that you're forced to sell your stocks, you could easily be selling these stocks at the worst time imaginable. And that's not what you're supposed to do, buying low and selling high. Quite the opposite actually. And considering the interest rates on margin are over 10% in most cases currently, It's going to be difficult to justify taking on debt to buy more stocks. You'll need some fantastic returns to make that trade worthwhile. I think Charlie Munger said it best in this quote. There are only 3 ways a smart person can go broke: liquor, ladies, and leverage. Margin being debt, which is a form of leverage, is that third L. So it's safe to say that margin can be incredibly risky. I'm not endorsing margin trading through making this video. In fact, I think using margin is a horrible idea. This video is simply a part of a larger video series on my channel about learning investing basics. Margin is certainly an investing tool that can be used effectively at times. If you'd like to learn more about the stock market, that playlist will be linked in the video description and the YouTube cards. Thanks for watching.